If AI can drive cars and diagnose diseases, the next logical question is whether it can tell you which stock to buy on Thursday. And Signode, writing for Technical Resources, actually sat down and worked through that question seriously.
This episode covers what AI can and cannot do in market analysis, from the fundamentals of how prediction models work to how AI tools are reshaping technical analysis on the ground in 2026.
Let's start with what AI in market analysis actually means in practice.
The core question here is a simple one with a complicated answer. Can AI predict stock prices? And if so, what does that prediction actually mean?
The post draws a distinction that matters. It puts it plainly. AI doesn't see the future, it sees patterns, probabilities, and possibilities.
So the upshot is that when a model outputs a signal, it's a probability estimate, not a guarantee. The post is specific. A model might say there's a 62% likelihood a stock rises over 5 trading days based on similar historical setups. That is meaningfully different from a price target on a given date.
Which is a useful corrective to every headline that promises an algorithm that beats the market. And there are a lot of those headlines.
The post walks through why accuracy degrades. Overfitting, model drift, data bias toward one market regime, and black swan events that have no historical precedent for the model to learn from. Garbage in, garbage out is the phrase used, and it applies directly to data quality.
The practical recommendation lands where you'd expect. Treat AI as a decision support assistant, not an oracle. Backtest across multiple market cycles, including downturns, not just the bull run your model was trained on.
The companion piece, how AI is changing technical analysis in 2026, makes the same argument from the other direction. Pattern recognition has genuinely scaled. AI scanners now catch combinations like an RSI divergence lining up with a volume dry-up near resistance across 3 timeframes simultaneously, across every ticker on an exchange, continuously.
That is legitimately impressive. The catch, which the piece is honest about, is that detection and validity are not the same thing. A model can correctly identify a cup and handle and still be flagging a setup that fails 60% of the time in the current regime.
The 2026 piece also covers chart copilots, AI assistants built into charting platforms that let traders ask questions in plain English and get annotated answers. For newer traders, it lowers the barrier to reading structure. For experienced ones, it's a speed tool for confirmation.
And for traders who skip learning the underlying analysis entirely, it is, the piece argues, a reliable way to automate their mistakes faster.
The workflow both posts converge on is the same. AI handles wide net scanning and data processing at scale, while a human sets strategy, applies risk limits, and makes the final call in conditions the model has never seen before.
The tools keep getting sharper. The uncertainty they're navigating doesn't.
The through line across both posts is that the tools have genuinely improved, and the markets have not become any more predictable.
Which means the next wave of questions is probably less about what AI can detect and more about whether traders trust themselves to know when it's wrong.